Welcome to the Deep Dive.
Great to be here.
Today, we're really focusing in on the financial headlines, the ones grabbing attention this Wednesday, May 21st. Specifically, 3 companies making some pretty big moves.
Yeah, 3 very different stories unfolding.
And our mission, really, is to get past the surface noise, understand what's really driving these market shifts.
Exactly, to give you a clearer view of, well, the potential opportunities and maybe the risks looking ahead to tomorrow, Thursday the 22nd.
We want to look beyond just the ticker symbols.
Right. These are stories about innovation, sometimes challenges, market dynamics. Today, we're diving into FICO. They're facing some regulatory heat. Then CoreWeave, which is just, well, booming with AI growth.
Riding that wave.
Totally. And finally, Amer Sports, celebrating a really strong earnings report. These aren't abstract things. They have real implications.
Okay, let's unpack the first one. Fair Isaac Corporation. FICO. I mean, everyone knows that name, right? Your FICO score. It's fundamental to U.S. consumer finance.
Absolutely fundamental. Mortgages, credit cards, it's everywhere. But lately, they've run into a bit of a wall, regulator-wise.
And it's pretty public, isn't it?
Yeah, that's what's striking. Bill Pult, he's the director of the FHFA, Federal Housing Finance Agency. He actually went on X, social media.
Right.
And voiced some, let's say, direct concerns, questioning FICO's pricing, the costs, even suggesting a big shift for mortgages.
Okay, what kind of shift?
Well, moving from what they call tri-merge credit reports, pulling from all 3 big bureaus down to just bi-merge, only using 2.
Whoa, okay, tri-merge to bi-merge for mortgages? That sounds like, well, a potential game changer?
It really could be. Lenders usually look at Equifax, Experian, and TransUnion for mortgages.
Right, for the full picture.
Exactly. Dropping one could disrupt how things have always been done, and, crucially, it could directly hit FICO's bottom line.
And the market noticed, I take it.
Oh, yeah. Immediately. FICO became the S&P 500's biggest loser today. The stock just tanked, down over 20% in the last couple of days.
20%. Wow. That's not just a bad day. That feels like it signals something deeper.
It does. It suggests maybe a fundamental change in how creditworthiness gets assessed, which, ultimately could affect your ability to get loans, maybe even rent an apartment.
And did it stop at FICO? Or were there ripples?
Definitely ripples. We saw competitors like Equifax feel some pressure too. Their stock dipped a bit. Online, you see terms like acute regulatory risk and uncertainty just buzzing around.
Uncertainty is the key word there.
It really is. So the big question for you, the listener, is how does FICO navigate this? Can they change their pricing, maybe their whole model?
And what does a potential move to bi-merge mean for you, for the accuracy of credit scoring?
Exactly. It's got potentially far-reaching consequences.
Okay. Quite the challenge for FICO. Let's shift gears now. Let's talk CoreWeave. Totally different world here.
Yeah, completely different. An AI hyperscaler backed by NVIDIA. If FICO's story is regulatory hurdles, CoreWeave is all about explosive growth.
Driven by that AI demand.
Insatiable demand, yeah. And the big news today is their financing. They just priced an upsized offering $2.0 billion in senior notes.
$2 billion, okay.
But here's the kicker. The offering was reportedly 5 times oversubscribed.
5 times? Seriously?
Seriously. That just speaks volumes about investor confidence in their AI play.
Wow. Okay, so the market really believes in this.
Yeah.
What about their actual performance?
Well, the numbers are, frankly, jaw-dropping. Q1 revenue, up over 400% year over year.
400%.
Yep. Reached nearly $1 billion, $981.6 million.
Okay, that is explosive growth. Is it profitable growth, though?
Good question. Their adjusted EBITDA margin was 62%, which is very strong. It shows the core operation is making good money before, interest and taxes.
62% margin. Impressive.
It suggests it's not just hype on the revenue line. There's a solid business underneath.
And what about future business?
Get this. A backlog of $25.9 billion.
Billion with a B.
With a B. And a huge chunk of that, $11.2 billion, is a deal with OpenAI.
Ah, OpenAI. Okay, that connects the dots.
Right. And remember, NVIDIA owns about 7% of CoreWeave, so they're really positioned as a key infrastructure player in this whole AI revolution.
Providing the picks and shovels for the AI gold rush, essentially.
That's a great way to put it. And no surprise, the stock reflected that today. Soared about 19%, hit a new all-time high.
So social media must be loving this one.
Oh, yeah. Lots of excitement, the NVIDIA link, the hypergrowth. It's a compelling narrative.
But is there another side to this? Any caution?
Definitely. You have to look at the full picture. Some analysts point to their pretty significant debt load and the fact that despite the revenue surge, they're still reporting operational losses on a GAAP basis.
Okay, so high growth, but also high debt, and still technically losing money on some measures.
Precisely, which leads to the fundamental question. Is this growth sustainable? Can it outrun the financial risks involved? It's moving so fast.
So, for you listening, is CoreWeave the poster child for AI potential outweighing the risks? And maybe more personally, how does this kind of AI infrastructure expansion eventually change the tech you use every day?
Good questions to ponder.
All right, let's move to our third company, Amer Sports. Global sports apparel, brands like Arc'teryx, Salomon, Wilson, names people know.
Right, very familiar brands. And their story today is quite different again. It's one of strong execution, really solid earnings that beat expectations.
An earnings triumph, some are calling it.
Yeah, I think that fits. While FICO's wrestling with regulators and CoreWeave's navigating hypergrowth, Amer Sports just delivered a clear Q1 win.
Okay, tell us about the numbers.
Overall revenue jumped 23%. That's 26% if you adjust for currency changes. It hit $1.473 billion, which was better than analysts expected.
Strong top line. What about earnings?
Even better, relatively speaking. Adjusted earnings per share, $0.27. The expectation was more like $15.19.
That's a significant beat.
It really is. Shows good cost management and pricing power.
Was the strength broad-based across their brands?
It seems so. Technical apparel, I think Arc'teryx up 28%. Outdoor performance, Salomon up 25%. Even ball and racket, Wilson saw a decent 12% rise. Pretty consistent.
Profitability.
Yep.
Margins.
Improved significantly. Gross margins expanded by 350 basis points, up to 57.8%.
Wow. Nearly 58% gross margin. That's healthy.
Very healthy. Suggests their brands command good prices and they're running efficiently, and it's made them optimistic.
They raised their forecast for the year.
They did. They bumped up their full-year guidance for 2025, now expecting revenue growth of 15-17% and adjusted EPS between $0.67 and 72 cents.
So they believe the momentum will continue.
Seems that way. The CEO, James Zhang, actually said the strong Q1 momentum is carrying into Q2.
And the market reaction? Positive.
Yep. Shares were up around 19% today as well. A good day for them.
What are people highlighting online about this? What's driving the positive sentiment?
A few things. The obvious brand strength, definitely. Also, their success with direct-to-consumer sales strategies. And interestingly, their strong performance in China, even with all the talk about U.S. tariffs.
Doing well in China despite trade tensions is notable.
It is. It shows resilience.
So the key takeaway here for you, the listener, regarding Amer Sports, it seems to be about the power of strong brands, right? And just effective execution in a tough global market.
Absolutely. What lessons can you maybe draw from how they build those brands, how they connect directly with customers, how they navigate tricky international markets?
Okay, so let's try and bring this all together. 3 deep dives today.
3 very distinct market stories. We had FICO facing down this pretty serious regulatory challenge, shaking investor confidence.
Right. Then CoreWeave, the AI infrastructure player.
Yeah.
Explosive growth, huge potential, but also, significant financial questions attached.
Definitely. And finally, Amer Sports. Strong brands, strong execution, delivering impressive earnings. A more traditional success story, perhaps.
So thinking about these 3 narratives, FICO's challenge, CoreWeave's potential, Amer Sports' success, which one do you find most compelling right now, and maybe why?
Is it the potential shakeup in something as fundamental as credit scoring?
Or is it the sheer speed and scale of the AI sector's growth with all its unknowns?
Or maybe the enduring strength of well-managed global brands.
It brings us to think about the longer-term implications too, right?
For sure. How might these regulatory shifts actually reshape finance? How will AI growth continue to transform, well, everything?
And what do successes like Amer Sports tell us about consumer behavior globally?
Yeah, lots to chew on there.
Okay, so here's a final thought for you to mull over. We've looked at regulation, disruptive tech, brand power, these big forces. But what quieter trends, what maybe overlooked factors might be simmering beneath the surface right now?
What could emerge to significantly impact the broader economy or specific sectors that we aren't focusing on quite as much today?
Something to keep an eye on as you navigate this constantly shifting market landscape.